Welcome to John's Friday Macro Coffee Hour. So, one of the things that I've been really thinking about is the yield curve officially inverted today. And it's been a really interesting one because I've been thinking a lot about risk. And so Warren Buffett's quote, it's one of those things that's always really sat well with me is one of my favorite quotes that he says is, "You don't know who's skinny dipping until the tide goes out." So right now, you've had a lot of people in the market, myself included, you're making money in the market hand over fist, things are going really well, and you start to be convinced that it's you, right? You're like, oh, I'm brighter than the average bear or whatnot. And there's two things that you have to think about. So one is called alpha and one is called beta. I don't know if you guys ever heard that before. But basically, alpha and beta is a measure of volatility when a stock is moving. So an example is you've got SPY, which tracks the S&P 500, and that's a 1x beta to the S&P 500. So if it goes up by 10%, then S&P 500 goes up 10%. But conversely, you have a derivative called SSO, and that goes up 2x. So when the market goes up by 10%, then SSO goes up by 20%. And conversely, if it goes down, then it'll go down 20% as well. And so there's a lot of people that have been making money in the stock market, and the truth is that they're doing well because they have taken on a lot of risk with a lot of kind of micro cap companies or high risk companies that have not great balance sheets, but they've got good growth. And that doesn't really go well in a recession, which is why you kind of saw a downturn on the tech side because people are taking risk off on assets. And the reason why that's important is because over the past 10 years, we've just been in the secular bull market. And now we have a lot of competing forces that I'm going to go through in other videos that are going to start pushing against that. And so you've got beta on one side, which is really just risk. And so if you're taking on more risk, you can get more return, but if it goes down, then you have to deal with those consequences. And on the other side, you have alpha. So alpha is a measure of skill, and that's basically if the market goes up by 10% and you're going up by 20%, but you don't have a beta of 2, you actually have skill that gets you that extra 10%, and that's what hedge funds and other people are trying to do. And you have a lot of people that have been convinced that what they're doing is skill when it's actually risk. And so we're not going to know in the short term, but we're certainly going to know in the long term, because when credit bubbles form, what happens is people generally get addicted to their own dopamine. They say, I'm a genius, and then we're all geniuses, and then we're not geniuses at some point. And so I think it's really important to stay humble during these times. I certainly don't know where the market's going to go. It could either go hyperinflation or it could go recession, but I do think the volatility is coming. I think that we have a lot of factors that are coming down the pipe that we really need to be considerate of, and I think that we need to not be addicted to our own dopamine and understand that we may have more risk in our portfolio than we believe, and so we need to really think about that and analyze it, right? If I'm holding things like Tesla that have 100 PE ratio plus, they're incredible companies. I mean, gosh, Elon Musk is one of the best entrepreneurs. He is, is one of my idols, one of my heroes. But at the same time, when I fundamentally look at a company like that, they're going to have to keep up a huge growth rate in order to keep those multiples, and it's pretty tough to do. And same with crypto, which, I have exposure to all of these different asset classes and these holdings, but at the same time, I'm starting to limit exposure to these different places because I understand that things could change over time, and you want to make sure that you're ready, you have some dry powder on the side for if the market does get volatile. I'm going to do separate videos that are really going to talk about the housing market. We watched interest rates hit 4.7% this week. I locked actually a house last week, and it was at 4.35. And I thought that was terrible. And now we're at 4.7 this week, and you have an inverting yield curve. And so we're going to watch some really significant volatility happen over the next little bit, because everyone, how credit markets work is when people's assets go up in value, they start feeling wealthy. And when they feel wealthy, it's credit, it's not actually cash. So if your house goes up in value, if you haven't sold your house yet, it's equity. So it's not actually real. It's not in your bank account, even though it feels real. But then when it drops, what happens at a psychological level, like let me ask you guys a question you can answer to yourself, is if the stock market dropped by 10% tomorrow or 20% tomorrow, do you guys think that you'd be making different purchasing decisions? And the answer for most of you guys is probably yeah. Because if I all of a sudden lost hundreds of thousands of dollars in a day, I would feel really, really bad. I would curb my spending decisions and how I look at things. And that's how the rest of the world works too. And so we're watching, really constrictive credit tightening happening right now with increasing of the Fed rate, with increasing of interest rates, which the Fed rate is going to affect APRs on credit cards, all of these different things down the line. Margin will become more expensive. And then that's really going to put a pinch on things. You've got gas prices at $6. You have all these different things happening. And so I think it's really important to really manage risk, partition it from what you believe skill is, because there's very few people in the world, maybe a handful of people in the whole world that have consistently beat the market for 30 years. And we always want to kind of remind ourselves, and sorry, I've said it 3 times, but it's important to understand that we have to partition and not think that we're stock market geniuses, even if we've done well, because ultimately, it's not where we do in 5 years, it's how we do over 40 years. And if we take a 50% drop in the market, it takes 100% to get back. Conversely, if you take a 25% drop, it takes much less to get back. And that's why managing downside risk is really important for hedge funds and other really big companies, because they understand how important that is over time. So if you guys find this content valuable, if you guys think that there are other counterpoints that I'm not looking at, I'm really going to start diving into a lot of these things. But as you guys can see, I'm kind of setting up the studio. I'm getting my thoughts together as I'm moving forward. I'm going to start putting out a ton more long form content. I'm really excited to be able to engage with you guys. I'm also going to start doing streaming as well, so I can kind of interact live, be able to answer questions in real time, because I want to be challenged. I want people to say, hey, I think this, I think that, and then we can go through it together, because my goal is not to be right. My goal is to find truth. And if I can find truth, I can make better decisions, and that's helpful for you guys, that's helpful for me, and it's important because, I just want to grow as a person, as an investor, as a business person, and it's important for me. So if you guys, let me know what you guys think, leave a comment down below, and I'm really looking forward to doing this in upcoming weeks. Talk to y'all soon.